Hey everyone, Adil here, and welcome to the August edition of the Surroundup. And I'm here to tell you that market timing doesn't work. So it's official. At the time of filming this video, the S&P 500 has doubled from its pandemic bottom, marking it the fastest bull market rally since World War II. You'll soon learn, if you don't know already, I'm a stat guy. That being said, here are the facts. The S&P 500 was at 2237 as of March 23rd, 2020, aka the bottom. It's now at 4479, making it 100% higher on a closing basis versus its COVID close. This means it took the market 354 trading days to get there, marking it the fastest bull market doubling off the bottom going back to World War II. For some context, on average, it takes the market over 1,000 trading days to reach that milestone. Naturally, the next question is, where do we go from here? Or better yet, does it even matter? Okay, sure, it matters for short-term speculative investors. If you're trying to get rich quick on cryptocurrency or the meme stock frenzy, or you're a day trader or a house flipper, then sure, short-term market moves matter. But for investors with a long-term view, market timing will only cause more damage than create value. And I get it, even long-term investors want to get their money in at an opportune time versus at the top. But guess what? Market timing is difficult, dare I say impossible, to get right on a consistent basis. Remember, you need to be right twice. First on the way out, and then on when to get back in. So does market timing even work? Let's say I was the worst market timer in the world and only invested my money at market peaks. What would I have to show for it? Well, if I invested at the height of the global financial crisis, I would have experienced an immediate 57% crash. But after 5 years, I would be up 5%. And after 10 years, I'd be up 104%. If I invested in March 2000, at the height of the tech bubble, just before the tech bust, this is an ugly one. After 5 years, I would still be down 5%. After 10 years, down 3%. But after 20 years, I would be up 219%. If I invested in October 1987, just before the Black Monday crash, I would have experienced an instant 34% drop. But after 5 years, I would be up 54%. After 10 years, I would be up 295%. After 20 years, 647%. And after 30 years, 1,431%. Finally, January 1973, the oil crisis. I would have experienced a 48% crash, followed by being down 1% after 5 years, up 91% after 10 years, 756% after 20 years, and 1,991% after 30 years. I know, this is a lot of numbers, but keep in mind, this was based on a 100% equity or stock portfolio. Many listening to this will say, I don't have 20 or 30 years. And to that, I would say, you wouldn't be in a 100% equity portfolio. You would be in a portfolio that fits your time horizon and protects you on the downturn. Sure, investing at the market peak versus the bottom will make a difference, but who can successfully make that call each time? My point is, even if you invest at the worst time and hold, long-term returns can still be favorable. And you're likely far better off versus sitting on the sideline waiting for the best time to invest or trying to time the market. I'm not trying to say that investing in the market is easy and that it doesn't come with many risks. And there's certainly no guarantees that the market will continue to go up. But historically speaking, if you're willing to be patient, investing in the market remains one of the best wealth-preserving and wealth-generating strategies, regardless of your timing. Well, that's it for this edition of the Surroundup. Until next time, always remember, there's more than one way to wealth.